Good morning, I'm Gary DeWaal, and this is Bridging the Week for August 20th to 24th, and today is August 27th, 2018. The Commodity Futures Trading Commission revised its rule related to the responsibilities of chief compliance officers of future commission merchants, swap dealers, and major swap dealers, as well as the obligation of such registrants related to their annual compliance reports they are mandated to prepare and file with the CFTC. The goal is to make the rules simpler and clearer. Separately, on August 22nd, the Securities and Exchange Commission, through its staff, declined to approve two exchanges' proposed rule changes to authorize the listing and trading of 9 exchange-traded funds based on CFTC-approved Bitcoin futures contracts. However, the following day, the SEC suspended its disapproval pending the full Commission's review. I get to leave on vacation later this week to climb mountains in Colorado. So I can store up my breath for the high elevations there. Let's get started. The Commodity Futures Trading Commission proposed amendments to its rule related to the requirements of chief compliance officers of future commission merchants, swap dealers, and major swap participants, as well as the obligations of such entities related to their preparation and submission of annual compliance reports to the CFTC. The goal of such rule changes is to make applicable obligations simpler and clearer. The CFTC also endeavored to better align its CCO and annual compliance report requirements with those of the Securities and Exchange Commission. Among the most impactful change is that the CFTC eliminated the requirement that a registrant address each applicable CFTC requirement that it is subject to in its annual compliance report when evaluating its written policy and procedures. Previously, this requirement could entail including many pages of detailed cross-references of procedures to law and rule sections in each annual report. However, according to the CFTC, quote, the CCO must still conduct an underlying assessment of the policy and procedures to meet the requirement of the rule, end of quote. It's not precisely clear what this entails. Notwithstanding, the final amended CCO and annual compliance report rule adopted by the CFTC provides some substantial clarification and simplification of existing requirements. The CFTC's new requirements will be effective 30 days after the date they are published in the Federal Register. The Securities and Exchange Commission declined on August 22nd to approve rule amendments proposed by NICE ARCA and SIPO BZX to authorize the listing and trading of shares of 9 exchange-traded funds that plan to seek exposure to some or all of the lead month Bitcoin futures contracts traded on the Chicago Mercantile Exchange, SIPO Futures Exchange, and or any other U.S. exchange that subsequently traded such Bitcoin futures contracts. This denial is by the SEC's Division of Trading and Markets pursuant to delegated authority. However, on August 23rd, the Commission stayed staff's denial and indicated it would review the delegated action. Generally, said the SEC, where there is a risk of manipulation in a market relevant to an ETF, the listing securities exchange should have a surveillance sharing agreement with a regulated market of significant size in order to, quote, provide a necessary deterrent to manipulation because they facilitate the availability of information to fully investigate a manipulation if it were to occur, end of quote. However, although acknowledging that both CME and CFE are markets regulated by the Commodity Futures Trading Commission, SEC staff said they were not markets of significant size because of their relative newness and low volume. Thus, claimed SEC staff, surveillance sharing agreements with CME and CFE did not meet the SEC's requirements. This is despite growing volume of Bitcoin futures, at least on CME, and the self-certification process of the CFTC by exchanges for new futures contracts that requires each exchange to affirm that their contracts comply with relevant law and CFTC requirements, including that their contracts are not readily susceptible to manipulation. So much for comedy. And finally, a federal court in Brooklyn, New York, entered an order of permanent injunction, imposed a civil penalty of approximately $871,000 US and ordered restitution of approximately $290,000 US against Cabbage Stack Corp. And Patrick McDonald, its owner and controller, in connection with a lawsuit brought by the Commodity Futures Trading Commission that charged the defendants with unlawfully soliciting customers to send money and virtual currencies for virtual currency trading advice and for the discretionary trading of virtual currencies. However, alleged to CFTC, the defendants did not provide the promised services and misappropriated their customers' funds. In ruling against the defendants, the federal court held that virtual currencies are commodities and that the CFTC had jurisdiction to bring its enforcement action, relying on the Dodd-Frank Wall Street Reform and Consumer Protection Act adopted fraud-based manipulation prohibition and a parallel CFTC rule. Well, that's it for this week's edition of Bridging the Week. As always, there is more information in each article and more articles on the article version of Bridging the Week on the website. That's www.bridgingtheweek.com. Check it out. I'm Gary DeWaal. Have a great 2 weeks. Until the next regularly scheduled edition of Bridging the Week on Tuesday, September 11th. Ciao.